Global markets are developing a clear case of technology disappetite as investors are quietly pushing AI darlings aside and rediscover value elsewhere. In this context, the Dow Jones Industrial Index, for example, printed fresh record highs last week in the US, even as the technology-heavy Nasdaq slid, dragged lower by earnings that failed to live up to lofty expectations from Broadcom and Oracle. Oracle, on top, added fuel to the fire by delaying data center projects by one more year, that is including the OpenAI circle, and even the reports of strong Chinese interest in Nvidia's H200 chips couldn't bring investors back to the market. So, risk-sensitive assets such as Bitcoin continue to feel the shift away from technology, and even with the Federal Reserve adding liquidity into the market these days through Treasury bill purchases, but not QE, investors are willing to see proof that AI spending can turn into real-world revenues. Until then, the market's mood suggests rotation. Not rapture though, but just rotation. So, welcome to Swissquote's Daily Market Talk. We are Monday, 15th of December. I'm İpek Özkardeskaya, and everything that we will discuss in this video are based on my own opinions. And of course, this is not financial advice. So last week ended on a mixed note for equities, and looking at the global indices' overall performances, the picture was telling a quite clear story of waning appetite for AI-related technology stocks versus other non-technology pockets of the market that are enjoying the latest Federal Reserve rate cut that just came last week, remember. So, the Dow Jones Industrial Index in this context hit a fresh all-time high level last Friday before retreating, while the technology-heavy Nasdaq 100 index dived 1.91% on Friday into its 50-day moving average. Quick reminder, Oracle and Broadcom earnings last week weren't stellar enough to convince investors to return on the back of a bull. They rather focused their attention on high leverage debts and cloudy outlook for revenue generation from these AI-related technology companies. Then Oracle's announcement that is pushing back the completion dates for some data centers developed for OpenAI from 2027 to 2028 due to labor and material shortages was the last nail in the coffin. Oracle lost another 4.5% on Friday after losing more than 10% the day before after releasing its third quarter results. And other assets tied to Oracle are doing quite poorly too. Oracle's new investment grade notes are now trading like junk bonds, and its 5-year CDS has spiked on Friday to a fresh high since 2009. And when the risk barometer of AI is doing so poorly, the kingpin of AI, which is Nvidia, is also suffering. The stock price fell more than 3% on Friday's trading session, and that despite the news that the Chinese companies have a strong interest for their H200 chips that they are now allowed to sell to the Chinese if they pay their 25 basis point cut to the US government on those Chinese sales. Reuters reported that the demand from China exceeds the production of these chips. The problem is there is no guarantee that the Chinese government, which is now rather propping up its own chip industry, will let the Chinese companies buy these chips from Nvidia as much as they wish. So I am afraid that China won't be the safety net to the AI bubble worries, not for now. And while Nvidia's revenues grow thanks to massive AI investments from the US big technology companies in particular for building their data centers that use Nvidia's chips among others, but investors are now willing to see actual revenue from the sale of AI boosted end products to gain their appetite back. And you could think, why investors will matter so much if the big technology companies are willing to spend more? Well, it matters because the investors are the ones who finance the spending by lending their money through their investment to AI companies through stock and bond purchases. And if they pull back their financial support, the companies will have to trim readjust their spending to the downside to please investors. And if that happens, Nvidia could also feel the pinch. And China may not save the day. So Bitcoin, which is the bellwether of risk and technology appetite these days, is under pressure. It was under pressure during this weekend. It is slightly better a bit this morning, but we are still below the $90,000 per coin level. At the time I'm talking this morning, Asian technology stocks opened the new week under renewed selling pressure as well, with SoftBank down by more than 6% at the time I'm talking here this morning. So if the global technology sell-off worsens, Bitcoin will likely be further impacted and could even retest and even break below the critical $80,000 support. Ooh, so that's pretty much it for technology. This week, Micron will be the next company announcing its earnings, and earnings there could add to the despair among technology investors if they're not stellar enough, and a technology meltdown could further rotate funds into the non-technology and even non-US assets of the market, because Dow Jones in the US is doing quite well, but the European stocks and FTSE 100 indices also amass capital from investors turning into more value-focused pockets of the market. And for the FTSE, a potential Bank of England rate cut this Thursday could even further back that appetite. The Bank of England is expected to lower its interest rates by 25 basis points when it meets this week, and is also expected to continue cutting rates to give support to the weakening British economy next year. Last Friday's growth numbers from the UK were quite ugly enough to back that expectation, and the government's budget measures will not improve the fortunes anytime soon, so the Bank of England will have to do some of the heavy lifting. And speaking of ugly economic data, the Chinese growth, sales and production data earlier this week looked terrible as well, hinting that in the absence of technology optimism for the Chinese companies, the Chinese markets would be in a very different place. But the good thing about that is that China will continue to support its economy by ample stimulus measures, and stimulus resonates quite well among investors. Elsewhere, the European Central Bank and the Bank of Japan will also announce their last monetary policy decisions of the year. The European Central Bank is expected to stay pat, citing that the European Central Bank policy looks near equilibrium and quite where it should be, and that they will continue to monitor the economic data to decide what to do next, while the Bank of Japan will likely hike the interest rates this week. This week's BOJ rate cut is happily mostly priced in the financial markets, with the 10-year JGB yield now pushing higher above the 1.95% level this morning, and the 30-year JGB yield flirting with the 3.40% level, rapidly closing the gap with the US 10-year yield that is now just 116 basis points above its Japanese 30-year peer. And the problem is that that increases the risk that the Japanese big treasury buyers would return their capital back home, and that would impact the US Treasury markets negatively as well. But don't panic just yet, because the good news is that the Fed begins buying approximately $40 billion per month of short-term US Treasury bills to back the banking system reserves and stabilize short-term funding markets like the repo and money markets after years of quantitative tightening that weighed on market liquidity. Be careful though, it is not QE, it's not quantitative tightening. These purchases will happen under the label reserve management operation. The goal here is not stated as stimulus or monetary policy easing, but as a technical way to ensure the banking system has enough reserves to hit the Fed's policy rate target and prevent strains in money markets. According to official operational schedules, the New York Fed plans over $54 billion in transactions over the next month, including roughly $40 billion in reserve management purchases from the Federal Reserve and reinvestments of principal from maturing securities. Now, why is this incredibly good news even though it's not QE? Because frankly, no matter if this is called QE, RMP, or whatever you want to call it, $40 billion treasury purchases from the Central Bank of the United States is $40 billion of liquidity joining the market that will go into stocks, bonds, metals, and wherever you can think of in the market, no matter what the purpose of the purchases is. So that's excellent news per se, and it's good for risk appetite. We will still have a look at the US NFP and CPI data this week, hoping that numbers wouldn't spoil the liquidity optimism. Remember, investors love soft NFP reads to justify further interest rate cuts from the Fed, but not too weak numbers either that would point at economic weakness that could then weigh on company earnings expectations. And on the inflation front, everyone wants inflation to further ease toward the Fed's 2% policy target, because the lower the inflation, the more Federal Reserve can cut rates and the stronger appetite will be. So it's again going to be a big week in terms of central bank decisions and economic data. We will talk about all that throughout this week, but it is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.